So there's buy side liquidity, and there's a minor buy side liquidity resting right above that 0.375 level. They're getting ready to engage that now. And then right in here, see all this inefficiency there? There's a volume imbalance and a continuation of a sell side imbalance, buy side inefficiency. So whenever you see that, this is actually another PD array where you have a candlestick low, it sells off, volume imbalance, and then we continue this sell side imbalance, buy side inefficiency, or SIBI, and then it would be shown here. So normally you would do it like this. This is what it might look like. And it's not technically wrong if you do it this way. You could do it like this. Or you could have drawn it like this, where you include the volume imbalance here. But if you have it as it leaves this candlestick low, comes down, creates a sell side imbalance, buy side inefficiency, that candlestick there, and then it creates a volume imbalance and then starts another downside closed candle, you have to encapsulate the entire thing to get the full range and the precision aspects that are afforded to you by having it. We had a nice attempt to go lower here, 1, 2, 3, 4, and it's shifted gears higher. We've taken out sell side, we've taken out buy side. The cleanest level, obviously, is this here. But if it fails to get there, this is where I would like to see it try to trade up into here. Kind of like to set the tone for the market before the 9:30 opening. I want to see how it uses this range, specifically this high right here, this high, and this low. Okay. So since we're looking at pre-session time before 9:30 opening bell Eastern time, the range that would be useful to me in observance is what I'm defining here. So it's this high here. So all the details that would be pertinent inside of that range is all that I'm concerning myself with at the moment. Now, the things I'd be looking at leading up to the 9:30 opening is how are we using these individual levels here? Are we using them in a defensive manner on all the sell-off, or are we aggressively running on these individuals that were already short overnight? And if there isn't a quick, sudden urge to get up into this inefficiency here, and if it gets to it and through it, does it treat it as an inversion? In other words, this level would turn orange. I would change the color to orange. If it trades up in the upper half of it, does it trade and go completely through it and not even come back down to the midpoint and just use the 8th level here? Again, these levels, these horizontal lines, are just simply me carrying over the opening range gap from yesterday, the regular trading hours opening range gap. And should we take out this high, obviously it's this relative equal high to that one. Okay, that's the level. But then we have this high here. So whenever I'm looking at like pre-session times before 9:30 opening, you might look at this and say, well, why wouldn't you have this high and this high? Because this one would be lower, right, than this one, and that should act as a draw on liquidity. Not when the level is so obvious like this. This is real close proximity, and they might just take it up here to bump that, stay inside the range, and never clear this. So when it's set up like this, I have to watch and observe because these are the very things I'm looking for how they're going to implement delivery during 9:30 to 10 o'clock in the morning. Said in a simpler way is because of the way these relative equal highs here are laid just below that high, and that high's bodies, look at where it's at. They're converging on the 8th, which is 0.125. So it's halfway between the high of the gap and it's the first quadrant. But between those 2 points is 0.125. So it's an eighth. So since it's formed here, they may keep this high intact and just simply use the range with these relative equal highs, if at all. But if they can't even get to this level here, that indicates to me it's decidedly weak, and they may just seek to completely run lower during the 9:30 to 10 o'clock opening range, which is the first 30 minutes of trading. So levels on the downside that could still be utilized if they want to sell off and be weak today. We have these down here. And that's the low of yesterday's regular trading hours opening range gap. We've already done enough on the downside to warrant a run at least up into here, and then see if there's any interest in this before we get into close session time of 9:30. So when you're brand new, the point is when you first sit down in front of the charts and you're trying to decipher what these things are trying to do, what these candlesticks are trying to indicate or tell a story, where's it going to next? Why should it go somewhere? And how should it behave? You have to make it very simple in the beginning. I have very simple models. I have very simple things. And it always started with this premise here, knowing where the market should draw to inside the range. Okay, so trading inside the range. I don't necessarily, and you don't necessarily need it to trade to this high to get into these relative equal highs. You don't need that. You don't need it to trade below that low. You don't need that. So inside of this low and this high, that is your range. That's your dealing range. So inside of this range, in that range, what you're looking for is where did it where did it reject pricing? Not say I'm not interested, but to simply say no, I'm not going any further. And the bodies and wicks show a clear indication that it has no interest in exploring lower or discovering price lower. That's seen here. We have it here, 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 and then here. So news at 8:30 sets the stage for these individuals that saw this little rally up. Anyone that went long on this, and there's always someone buying and there's always someone going short. It's always like that. Okay. Them coming down before 8:30, taking out that liquidity and failing to get to that eighth level. See that blue line right there? Right there. It didn't even get to that. And then it turned gears and then dropped back down into an inversion fair value gap, which is this right there. This is not inefficiency because we have this wick laid over top of it and it cleared this candlestick's high. See this green candle here? The one immediately after the lowest down closed black closed candle. That candle right there, its wick, it goes just above the previous candle's high. If it had not done this, okay, if it had not done that and it stayed inside of this candlestick's low, if this candlestick's wick would have been lower than that, this wick, I would have looked past it and considered this as a different type of PD array. That would be a discount array. But the fact that we went below these lows here and we failed to even touch that lower eighth down here, that line right there. It changed gears, came back up and dropped down into this inversion fair value gap. This inversion fair value gap is part of this breaker. So these lows create the liquidity pool. This is the fulcrum point right here. Then we drive down, take the liquidity out below there, and then this right there, that is your inversion fair value gap. This is an A plus setup because you have several things here. You have liquidity that's left in the marketplace. They come down ahead of news. They take that liquidity. They don't go to a level that if it was weak, it should have came down here at that time. It didn't do it. And then it rallied back above the SIBI, the lowest portion of a bullish breaker. That right there, we trade above it, come right back down. Yes, we have a little bit of a wick that goes through that. That's fine. It's not a big deal. Where's the body stopping at? That right there is indicative of seeing how price is being held. It's being held in a way where you can see that's that's not buying and selling pressure, because the question would be is why would everybody stop wanting to go short here at that level that's dotted here? Why would they want to stop going short there and only go long? And how does that shift in buying overtake the selling when it's a net sum zero game where every buy and sell is equal? Because the algorithm's going to keep offering higher prices whether there's buyers or sellers there or not. and it's going to take a run into that liquidity, which I told you we're going to watch this. That's a minor buy side liquidity pool, and this inefficiency, which it just so happened to trade right up into. And I said, when we have to watch and see how it trades when it trades to this inefficiency. So far, it's already lending premium sensitivity. That means it's not willing to press that hard up into it, and we have to sit and wait. We have to watch. But this run from here to there as a partial and to this inefficiencies low, which it hits it there, that in and of itself is a model. You could be done. You could be completely done. I didn't talk about going short. I didn't say, come down here and look at this level. We're going to wait. I said, looking at this range, what I like to do is I look for price that shows relative equal highs and relative equal lows. We've already made this jagged on the downside, but I'm looking for where it's smooth, and the market's going to gravitate towards that. The levels that are smooth after levels that have been made jagged, okay, and if you're first time hearing that, what that means is where the market has ripped lower, 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 lower. There's nothing smooth down here. In other words, nothing in terms of a relative equal low. They just keep taking it lower, 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 and then there's a shift in market structure. And then by keying off of this sell sign of balance, buy sign efficiency as a inversion fair value gap, Dodgy, you can start including this now. The eighth, you can see it's also laying right on top of that as well. So again, this level here, this line, that is part of the regular trading hours opening range gap from yesterday. Okay. So it forms right there. So you're going to tell me now everybody's trading the eighths on an opening range gap from a previous day after the gap closes. See, it doesn't hold water, does it? You already remove 90% of the struggle if you can define the range that price is trading inside of, which is what I did here. That low and that high. So inside of that range here, if you have doubts about holding on to a trade too long, or you're brand new, or you're afraid that the market's going to reverse, which it can do in these current conditions because it's extremely volatile, but you have to learn how to frame a range and then get comfortable trading inside that range and not needing it to do anything more than trade inside two reference points, which is that one here and this one here. And you can make all the money you'd ever need trading just in that. But by having a defined range or a dealing range that you're operating inside of, number one, it frees up the necessity for you to know where the next big run's going to be. That's not important when you first start. What you're learning is to define where price can stay inside the lines. Okay. When the markets create these big runs, they're always coloring outside the lines to do that. And in the beginning, you are not, I don't care who tells you otherwise, you are not equipped to know that right away. In the beginning, try not to hit grand slam home runs. You just need base hits. Okay. Base hits, I promise you, base hits make millionaires. What's a base hit? Buying that inversion fair value gap and just getting out at that high right there. If you can't define the range that we're inside of right now, you're lost. The first time I went out on a live stream, I said, this is what you should learn right now, which is this premise here. Where are we at? No, what benefits do you derive from having determined a range that we're trading inside of? Well, it limits your need to be right about how far the market's going to go. You're only looking for something that's very simple inside of the range. Now watch. I told you this high here because it's the lower of the relative equal highs. The buy side's sitting right there, but that's a minor buy side too. And this is the most reactionary between the two highs. Whereas this one, we dropped down, we went into consolidation just to come back to that. So this more energy and more energetic sell-off from here down to there. But liquidity-wise, if it's going to take that high, it wouldn't be a far stretch of the imagination to see it want to clear that as well. So to make things very simple and also to reduce the necessity about being right, just use that lower high as the high of your range. And then because we traded down to that low ahead of the 8:30 news, And if you go to forexfactory.com or if you use Econoday's economic calendar, you'll see at 8:30 today, we had the unemployment claims for jobs in the US. So that's a red folder or what we call a high impact news driver. Well, news is an injection of volatility. So it also kind of like forces the market to show its hand to you, meaning that who's it victimizing? Who's it going after with the news or shortly after the news? Okay. And 8:30, whether there's news there or not on the calendar, always is an algorithmic time to anticipate some kind of a measurable price run. So by having that determined that this is when you want to be watching price action, you'll see these signatures. That means these things that repeat over and over and over again. They're not patterns, they're signatures, things that generally repeat. That means it runs for liquidity or it runs for inefficiency above and below the marketplace. I mapped out in the range that I defined for you here. That was the high of the range, that was the low. I said there was a minor buy side here, and then this inefficiency right here, and I taught you that PD array, which is two SIBIs connected with the volume and bounce in the middle. So you have to do the entire thing. It trades right up to it, bumps the bottom of it. And I said we had to watch and see because why? If you look at the high to that low, that's in the upper quadrant or OTE, optimal trade entry. So you have to see if it can go up there and trade into it. And if it does, we wait for it to trade the upper half and then stay outside the lower half. And then you would expect it to run higher. But it didn't even do that, did it? Where did it trade to? Right to the low of it. And now we're seeing what? Sensitivity. It trades from the low. Why is it so sharp selling off? Because we had the inability to get to this eighth on the opening range gap from yesterday's regular trading hours opening range gap. So it hit the low of it, had no interest at all putting a body inside the range, traded lower, broke through another eighth down to another eighth. Liquidity is resting right below here. If you can find the ability in yourself to frame a measurable outcome that doesn't have moving parts that change and morph and to do all these different things all the time, where it's always impossible for you to know what you're doing. In other words, you frame a model that's useful, it's simple. How is this simple? It was jagged by dropping, and nothing relative equal low down here. At 8:30, news driver came up. I took your attention to this high here, minor buy side. I said this inefficiency and these relative equal highs, but then I aimed right to that high there. Okay, so the dealing range is high to low. 3/4 of that range is optimal trade entry. That's limiting your focus between this high down to that low. 3/4 of the range is here. So what do you have? You have a short-term high there, but we don't need to mention that because it's already part of this PD array. So this is the inefficiency. This is the liquidity. This was a minor buy-side liquidity pool. The attention was focused to the upside. It went lower, lower, lower. It was made jagged. Inversion fair value gap. Lays over top of an eighth on the regular trading hours. Opening range gap. And then it rallies up to minor buy side. That in and of itself, if you're brand new, that is what is realistic for you. That's realistic. That's something that will repeat every single trading day. Not this overall thing, but looking for a very simple run to a minor buy side or a minor sell side liquidity pool. So to avoid that, as an educator, when I tell you to look for very simple, small price runs that are predictable, little cookie cutters where you can take this little cookie cutter. Cookie cutter is the market's in a discount. The nearest premium liquidity is that high right here. And then I said the next one is here, but that's inefficiency. It's not liquidity, it's inefficiency. But above that short-term high here, that is liquidity. And it did both. Bump, hit that, and that was it. But we did not see any exploration into that inefficiency on the upside. It just touched the low of it here and then gave up the ghost and went lower. Here to here, low hanging fruit objective, very easy type trading, very cookie cutter. It's not hard, it's not complicated, it's not complex, it's not a lot of moving parts. It's very, very simple things. It's low in price and it's going to reach for a higher price. Which is easier to find? The short-term high here or an inefficiency? The short-term high. Why? Because look, when it came up to that high, look how energetic it was when it dropped. So as it dropped, anyone that was short here or anywhere back here, what's their mindset when they see this big sell-off and it creates another lower low? They're going to lower their stop loss, protecting their short position to just above that high. And what's it going to be? It's going to be a buy stop, because to get out of a short position, you have to buy it back. And protecting your short, you're going to place a buy stop above some kind of an old high. Every discipline teaches that. As they're short, they're trailing their stop loss down because they don't want to have this type of run here and knock them out and have a larger loss. For the people that had their short position protected with this short-term high here, they didn't see this idea as a viable level to put their protective buy stop on when they're short. They were thinking it's probably too close, give it some room. So they kept their stop up here. Every single day, do these types of things. Look where the market's jagged and where it's left smooth levels. Wait to a time of like 8:30 and 9:30. They're starting points. Boom, the gun goes off, everybody starts running. That's what happens at 8:30. The same thing happens at 9:30. And at 3 o'clock, the race has been ran all day long. And then you wait and you see which one's the strongest one that finishes the best. And there's a flurry of little action that goes in the last hour trading, 3 o'clock and the 4 o'clock closing. That's the simplest way of describing what goes on in the marketplace every single day. You don't have to have a whole lot of things out of my toolbox. You don't need a lot of that stuff, but you do need to know when prices generally create some kind of volatility and where it runs. Not directionally yet. You're going to learn that, but when it starts to run, that's 8:30 and 9:30. Okay, so because of those opening times, one's related to the news, which is 8:30. Whether there's any news event on the economic calendar or not, 8:30 in the morning Eastern time always is a time where the market will. It's like you'll be surprised if you start studying it. When there's no news on the economic calendar, all of a sudden it creates these runs exactly at 8:30. Buying here and getting out here, that's the lowest hanging fruit, easy objective. Just get in there and do those every single day. Find the smallest little price run from one point of entry to a pool of liquidity or an inefficiency. Now, an inefficiency in here would be like this. Okay. But if it's going to go from here to here, that's not really not, it doesn't do it for me. Like if it's going to run from here, it's going to run to this short-term high, which is why I told you in the stream before it went there, there's a minor buy side there. And then I like this inefficiency here. And it need not even trade up to the relative equal highs, because this is 3/4 of the run from low to high. Okay. So 3/4 of that run is this. And I'm telling you here, like I've done dozens of other times, how to start. Simple. Very, very simple. You only need a small little cookie cutter move, something that repeats over and over and over again. What is that? A run from an inefficiency to a liquidity pool, or from an inefficiency to a liquidity pool moving lower. Or once you learn, you can trade a liquidity pool to an inefficiency, or from one liquidity pool to another liquidity pool. That's a little bit higher terms of trust in what you're doing. That means like trading a false breakout above an old high down to a false breakout below an old low. In other words, it would look like this. That high, we traded to here, and then expect that low to be taken out. That takes a little bit more experience to do that. That's the highest form of what I teach. That's the highest one. And even that's not all that complex. But when you first look at it and you're thinking, but where's the propulsion block fit in all this? See what you're doing? So when you're looking at the range, you simply got to say, okay, I'm only interested in previous hour and a half, previous hour, the previous 30 minutes. Okay. If you're looking at less than 1 minute time frames, you can do this all day long, by the way. By having the range defined, as we outlined here, knowing an initial expectation of wanting to run against those individuals that were short overnight during the pre-market session, 7 o'clock, the market's dropping down. We're going into news at 8:30. So what is it going to do? If it's jagged down on the lows, look for where it's smooth. When you have it determine where it's smooth, then define the range. And to keep things very, very simple, use the smaller reference point when you're defining the range, which is what I did here. If you would have used that, it still would have been fine, because below that high, you still have this inefficiency. This was the focal point. This was the high of the range. I said, we'll see if it wants to reach up in here, but I don't need it. You don't need it. Go back and listen to the stream. You don't need that, which means what? I'm disarming you. Don't expect it. Look for something simpler. What was that? This minor buy side and this inefficiency. It trades right up into it. So as you graduate and you start watching the tape from here to here, then you start thinking, okay, I'm expecting a run from here to here. And then let's play devil's advocate and say I have 2 micros on. Then I can see if I can tag that low of that shaded box, which is an inefficiency. And that could be my final close or terminus on the trade. So you have 2 states exit. Enter, partial at the high, exit there. You have to know where it's likely to go to next and not be on the wrong side. That's the first lesson in trading, folks. You have to know where it's going first. Where is it going? Sit down on the chart. Boom. Where's it going next? If you don't clearly know where it's going to go to, you have no chance of being profitable. Zero chance. And you wonder why you can't make money. You have to have a very boring skill set that simply sits you down in front of the charts and you say, okay, I believe the market's going to go to this level, and this is the reason why. Because it's already shown its willingness to not go any lower here. It's a time when the market's going to start running, 8:30 news, and it's going to run against the range that was defined on overnight on pre-session 7 o'clock shorts. Where's the range high and low? Where's 3/4 of it? Why am I talking about 3/4 of it? Because with the market maker sell model, it can go up into 3/4 of the range and not come back to the original consolidation. And that's what you saw here. And then it fails there. It never even goes back to the original consolidation. You won't know when the market maker buy sell models complete. You'll get tripped up and you'll be in a trade that's making money. And you'll be like, I got it. It's so easy. It's so easy. And then it does these types of things here. And it reverses on you. And it's like, oh, they're changing the algorithm. That son of a bitch ICT. So you start simple, very, very simple things. Look for where you're at in terms of the range. Look for very simplistic entry models, not a lot of moving parts, very simple things. Jagged time when the market's going to do what? It's going to run against positions because it's an 8:30 opening. Whether it's news on the calendar or not, it's going to do it. At 9:30, it's going to do the same thing. Okay, it's a mechanism that it does it. So the idea of determining your range gives you a canvas, like Bob Ross, the painter. The canvas was this high to that low. So what am I going to do? I'm going to paint a masterpiece and tell you where the market's going to draw to. It's going to go up, and to what levels. That inefficiency, and it hit it perfectly, and then sold off. So now we're below here. Now the range is now defined to this, and we're getting ready to go to 9:30 opening. Now we've entered regular trading hours time frame. This liquidity pool is still factor. Okay, so inside of the pre-market session, we had this range down to that low, and we worked inside that. Now we just dip down into, look at that low. Look at the low. Look at the low of that candle up here. 26,122.5. That's exactly the price level here. That's referenced from yesterday's regular trading hours opening range gap. So let's go over to regular trading hours view. Okay. And this is the gap that is running the close in. Here is the 9:30 opening, that price right there. And then we have the regular trading hours settlement price on that candlestick right there. And then go back into electronic trading hours. So here's settlement from yesterday, regular trading hours. We came up into that by how much? So there's your gradient levels. So we went up, traded into 0.375 level. So far, I gave up the ghost a little bit. remaining portion of the opening range gap is here. So that would look like this. This is what you have remaining on the day for gap closure. From regular trading hours again, what pool of liquidity or inefficiency? We have this one, and we have this one here. And it's regular trading hours. I'm sorry, electronic trading hours. So if it continues to drop lower, I'd want to see sensitivity in either one of these. No initial first visit to fair value gap yet. Because we're outside of the opening range, meaning that here's where we opened, and that's where we opened from. In other words, we have a discount gap opening. We're below it now, so we're in exploration. So we're inside of that first fair value gap, upper quadrant of it now. Half would be here, lower quadrant here, full closure and pierce through it. And then if it starts to sell off more, this is the one that it would have to, if it wants to come back for this during the session, it would need to show sensitivity down here, but that's a draw. When we're outside of the opening range gap, as soon as we break out of that, and it doesn't need to be 15 minutes, okay? It doesn't need to be 30 minutes. It just means that once we have the opening price, if we have a partial fill, which is what we have here, it's almost like a 3/4 of a closure on it, then it rips lower. You have to anticipate it reaching for deeper discounts and simply going to regular trading hours. In the old regular trading hours price action, don't just simply look at electronic trading hours. Look at regular trading hours and see what they're going to reference. Okay, so this is your first skill set. You have to know these types of things. Where is it going to draw to? Why should it draw? Knowing what it's reaching for. They're the beginning basis points of how you're going to find trade setups. If you can't pick the right direction, if you can't do that, you have no chance. If it goes right through here on the downside and just keeps on running, I would have no interest in having this at all for the session in the morning. And I would just simply move to wait until the afternoon, get through lunch, and come around 1:30, sit down and watch the price action and see if there's anything smooth that needs to run after. Where's the sell side or buy side that they left intact? And I would use that for the PM session. Looking at the initial run here, 9:30, 9:31 candle, bumps the high there, just enough to clear these little tweezer highs. Isn't that pretty? Right there, clips it, rejects it, comes back to the opening price here. We open, trade up to it there, sell off, then reach for the PD raise outline. But now this is really heavy. Let's go to regular trading hours again. Right below here is the liquidity for anyone that was long. That's what they're going to target. They're going to target that right there. This range here on the upside, buy side of balance, sell side efficiency. We traded down to it and through it. So if they want this low, I would like to see them respect the upper half of this. Don't come back up into it with any bodies. It can come back to the halfway point and wick into it. I'd prefer it not to do that. But keeping its bodies in the lower half or under it is even all the better. And that's supportive of a run into that liquidity. If it can run up and start laying bodies down in the upper half of that blue box, that makes it far less likely that they're going to reach for that liquidity before a deeper retracement. So in essence, what I'm teaching you is how to anticipate inversion fair value gap and how to categorize and classify when they should be implemented, when they shouldn't be implemented, what are problems that arise when you anticipate them behaving as such, what would negate it? What are you looking for to support the idea? Where it leaves pools of inefficiency here, that's the type of price action I'm looking for when I'm trading. So if the market is not it's not leaving a porous wake behind it when it's running up or down, that means leaving inefficiencies like this. Chances are I'm not betting my heaviest hand, that's for certain. But if we're spending a lot of time back and forth over top of previous candles, that's what I refer to as fuzzy. It's like fuzzy. It's sharing the same space with previous ranges. So to me, I don't want that. That's not algorithmic. That is intervention. That is them working previous ranges, constantly going after orders because they're greedy. They're trying to knock everybody out. And when they're knocking these individuals out, they're accumulating that. I think I covered a really good sound approach. That's where you start, what you're looking for, how to transition from regular trading hours and electronic trading hours, what information you're trying to derive from that. Developing the range, um, determining what that range is going to be in pre-session and how it's used, and using the opening range when we get it at 9:30. We immediately went outside of it here after almost a 3/4 of a run to it, then used the opening price, which is very sensitive, just like the midnight Eastern time opening price. That is many times like a magnet. It's very sensitive. It also helps with the daily directional bias. Here, we have the open. It trades up. There's your Judas. It breaks down, hits it there, and then breaks lower. Your first presented fair value gap would be here. Yes, there's a small little gap there. I would not use that because we had this box here I highlighted. It displaced into that there. So this candlestick's low, this candlestick's high. So there's my election for first presented fair value gap, and it's because I told you the inefficiency from regular trading hours. It displaced into that, and this would be just viewed as a regular old breakaway common gap. That's why I wouldn't use it, and it doesn't have that much of a range versus this one. There you go. There's your chart. There's your delivery. First step is this. If you can't see where it's going, why it's going there, you can't do entries. Don't try to pick entries yet. Just try to pick the direction. Where is it drawing to? And then once you have that, then you can go back through in hindsight and say, what do I see in here that makes sense? Do you see a fair value gap? Do you see them running back to a breaker before it runs? Do you see a silver bullet? Do you see the market maker models in price action? In the beginning, you won't because you just started looking at it. But anyway, what I've shared today, if I would have had this given to me when I first started, it would have saved me a lot of heartache. It would have gave me direction. It would have gave me a procedure to do every single day, go through the motions of determining where it's going to reach for. And then after the day completes or the session completes, okay, what do I mean by that? Around noon, go back and look at the morning session from 7 o'clock in the morning to 9:30 and from 9:30 to noon, and go back through and see how the market reached for inefficiency, how it reached for liquidity, how it expanded in its daily range. What side of the marketplace was it working towards most? How fast was it easily giving up the desire to go higher or lower? Like all these things, you need to log that stuff. And then because you're doing it every day, you're implementing a process that you don't see the benefit of in the beginning. But time doing it will yield the experience that you don't appreciate by me saying, this is how you get here. How do you know where it's going to go there next? How do you know? How did you know that? Because I submitted myself to these things. And it wasn't fun in the beginning. It was very, very boring. And then I noticed that there was repeating things. And look here. And look here. And that's how it happened. And maybe he'll do the same thing for you. I believe he can do it. Do you believe it? Um, for the groups that are brand new, looking for what you're supposed to do in the beginning, it's all you're doing is trying to get a feel for where it's reaching for. That's the first lesson I ever taught, and that's what you're doing now. The draw on liquidity, where should it reach? And then you fill in the gaps. Go back and look at how the PD arrays formed. And then the ones that jump off the chart at you in hindsight study, not live. Some of you want the silver bullet to appear and be able to spot it right away because you understand the idea, but you don't know how to implement it real time. And you're getting frustrated because you can't enter a trade based on it. And you equate that as it doesn't work or you can't ever do it. And you're just simply jumping ahead of several steps. You can't do that. When we had the opening range from where we open at 9:30, difference between where we settled the previous day at regular trading hours, that was this line here. Okay, let me go back to regular trading hours. There's the opening this morning at 9:30, and that's the settlement price yesterday, the close of that green candle. That's these two lines here, okay? I'm gonna just shade it in the blue box just to highlight that, and then we'll go back to electronic trading hours. You will find that when I was teaching on opening range on indices, that when we open and we create the gap, trade up into half gap, 3/4 gap, 1/4 gap, if it breaks outside of the gap, the open, and starts to run, then you have to respect the fact that it's probably going to leave that open. And as I mentioned, I said if we go through here, if it went through here and sliced through that on a closing basis, then I would abandon this gap closure portion up here during the morning session, and it would remain heavy. And you can see that happening here. Where is it drawing to? There's your secret. That's the secret ingredient. Where is it drawing to? If you know that, you can trade retail concepts if you get the draw right. Look at it. Opening price, hits it, and never came back. Never came back. So, barring some crazy sell-off where it just doesn't want to come back at all and it just melts today, I would expect, gravitating back into this eventually before the close of the week. That doesn't mean it gets to that level, but gravitating back to first presented fair value gap because they're a magnet. They're like new week opening gaps. They're like new day opening gaps. You need to draw on liquidity. You need to be able to frame risk. So that means where a stop loss is. And you need an entry mechanism. There's your 3 paintbrushes. Which paintbrush are you going to use? You're all going to use the same canvas. We're all looking at the same chart. The same amount of time, the reference of where price has been, where is it likely to go. Everybody has that. It's not hiding from anyone. We all have the same information. But knowing what to do with that separates profitability and unprofitability.